Hey everybody, Jack Gibson and Jeff Schechter, aka Shecky with High Return Real Estate. And today we want to talk to you about what is high return real estate. So when you're investing into real estate, we know that, a lot of us know anyways, that there's a lot of money that can be made in real estate. Actually, more millionaires have been created in real estate than any other asset class. So how can you get it done, Shecky, to create wealth and create high returns?
Well, it's a great question, and let's start off by looking at national averages, right? So there's a term that's thrown around called cap rate, and that really just means the return that you would get, the return on investment after expenses that you would get on a property.
So if I invest $100,000 and I get $5,000 net income at the end of the day, then my cap rate is a 5.
Correct. Then your cap rate is 5. Exactly right. So, and interestingly, that example is very, very close to the national U.S. average across the board. It actually hovers a little bit below 5. So what we look at as high return real estate is anything that's approximately double that. So anything that we're seeing that's 9% or higher, which is obviously significantly better return on income, is what we would be our, granted, somewhat arbitrary definition of what's considered high return real estate. So the important thing to recognize here is, how is that calculated? Because as you can imagine, in the world of real estate, there are a lot of people trying to calculate things differently or massaging numbers slightly differently to make their numbers look better. In our world, we believe in just no fluff and complete transparency, and saying, what is it that are the real expenses that you are going to have against this property, the way it is performing right now, not the way it might be performing next year with projections or with possible rent increases or any of that stuff. Let's look at the rent we're getting right now. Let's look at the price we're paying for the property right now. Let's go out and get an actual insurance quote, because we know that we're going to have to insure that property. That's going to be a real expense. Let's look at exactly what the city, county, taxing authorities are charging for taxes right now, because we know that that's a legitimate expense. We feel that if a property is rehabbed correctly, that 5% of the rent is a fairly realistic number for putting aside in your kitty every month to cover future repairs and maintenance. And then lastly, obviously the most important one is going to be vacancy rate, because that's where things are going to fluctuate a lot. Now we're in C-class properties, and we know that we typically have slightly higher vacancy rates in C-class, so we'll oftentimes account for even double digits in the vacancy rates. So when all that stuff is plugged in, then and only after you've put in all those expenses, can you then come out with at what your cash on cash ROI percentage is. That's really the defining number. Now, if that number is then 9, 10, 11, 12% cash on cash ROI, now you know you've got a high return real estate product. You've got something that will perform well for you for many, many years to come.
So you see a lot of cash flow projections from companies where they're factoring in what's called the internal rate of return, right? So they are projecting with that oh yes, you're going to eventually sell this property, and then you're going to capture additional equity, additional return on investment at that point, right? So what you're saying is, okay, that's great. That's certainly part of investing into real estate, but we're not factoring that into this equation. This is strictly the here and now present numbers.
No, in fact, not only are we not factoring that in, but when we look at things in the future, we're factoring in future repairs, we're factoring in future vacancy rates. So we're actually factoring in the things that will cost us, not the things that are assumed appreciation. We're taking the negative side. So that's what I mean by being completely transparent and saying, hey, look, let's just look at the reality of what's going on and the probability of seeing those expenses into the future, so that we're not deluding ourselves into thinking we're buying something more than what it really is.
Because at the end of the day, any forecast about possible rent increases or possible appreciation is merely speculation. Nobody knows.
It's fluffy.
It's
There's
fluffy,
no question.
right?
Yeah, exactly.
Well, there's no fluff here at High Return Real Estate. We're just looking at delivering solid performing, solid transparent numbers. So if you're interested in learning more about what we do and the type of properties that we offer, please visit our website, highreturnrealestate.com. Also, for additional insight into these and many other topics, please subscribe to our podcast show, The High Return Real Estate Show. And with that, thanks so much for watching. Have a great day.